really the elephant in the room in franchising, and that is money. How much does it take? How can we get it? When do we get it? All of the different factors with that. So we're going to go into that in great detail. First, again, who are we? So FranCoach, we are a national search firm dedicated to working with individuals like yourself who are interested in owning a franchise. We are partnered with well over 600 of the top franchisors in the country, and that spans nearly 70 different industries. Our goal is to help clients find the absolute best franchise for them to own. There's usually 4 or 5 different potential ways to make this happen. In many cases, just at the most basic level, we like to equate this to buying a house. So when you go to buy a house, in most cases, unless you were total baller-esque and you're just gonna like, here, let me stroke you a check for $750,000 and give me the keys. The rest of us, we're gonna put a down payment on the house. We're gonna get a loan to pay the mortgage. So whatever that down payment is, maybe it's 20%. We just kind of have that understanding. We need that. Then we get the house. We've got the loan to pay the rest. Probably the most common, or certainly one of the 2 most common methods of franchise funding is going to be a loan through the SBA, the Small Business Administration. So with the SBA, there is going to be a lot of similarities to buying a house. So you're going to need cash up front. In many cases with the SBA, 20 to 30% of the loan amount is required as what they're going to call a cash injection into the business, your down payment. There can be at times up to another 20% of the loan value in what they're going to refer to as post-closing liquidity. It's a fancy term for, do you have money to pay us back while the business is getting ramped up as the bank? Because let's be honest, all they really care about is that you're going to pay them back. So the SBA, there is going to be a good chunk of cash, even on what's commonly referred to as an express loan, which is for up to $150,000. That's going to be all of your non-retail, your service-based type of things. $150,000 loan, 20 to 30%. You're going to be in somewhere in that $30,000, $40,000 range. Have a little bit in your pocket once you have the loan for that post-closing liquidity. Credit score, the ballpark of 700, sometimes a little bit less. I just said the 700 is a clean number. There's always some debt ratio and things like that are going to be mixed in there. You don't always have to own a home for this, what's called a 7A loan, which is like 250 and above. In most cases, that is there. Interest rate is variable. Guess what, folks? It's higher now, 2% over prime. Variable means it's going to come back down at some point as well. There are always kind of loan origination fees, again, just like buying a house, right? So can you do that? In many cases, yes, it's the most common and most similar to what we're used to in buying a house. A couple things that are different with this so people understand the timeline. Like last week, we talked about what happens after signing the franchise agreement and how long it takes to get open. Part of an SBA loan is tied to the getting open. So you don't get the loan to pay the franchise fee. You don't get the loan for the house to pay the deposit. You've got to come with the down payment. You've got to have that, right? So same thing with an SBA loan. You have to have the franchise agreement signed, which means you have to have the franchise fee paid, typically in full. Sometimes we can get away with a little bit of a deposit with that. You have to have any level of training with the franchise done before getting the loan. If there is a lease, that has to be signed before you get the loan. And if it's a franchise, it requires any sort of license, sometimes things in the home service, anything medical, things of that nature, that typically has to be acquired as well. So definitely some hurdles, probably the most complex loan for all the different things that go with it, but still a really common thing. Just know you got to be coming to the table with some cash, usually 20 to 30% of what you're going to need for the loan at a minimum. That's SBA. One of the more common things that people don't know you can do is what's called a ROBS, which is a rollover for business startup. So this is going to allow somebody to use their own money that's in a retirement, a 401k, some IRAs. You can actually take that money, is essentially reallocating it. We know that when we withdraw the money out of those things, we get hit with penalties and we get hit with the taxes for how much that just added to our taxable income for the year. When we use the ROBS, none of those things happen. It's essentially taking it from your existing account. Our partners are going to help you set up a new, basically 401k account, and then you're allowed to use any and all of that money for your business startup not taxed, not penalized. So it is essentially using your own money to invest in the business. With the ROBS, credit score doesn't matter. You can have the lowest credit score ever. You can still get this. Doesn't require any cash up front. Not a lot of hurdles to jump through. They're going to set all of this up for you. Usually takes about 30 days and that cash is in your hands, essentially ready to use. Obviously, there's some fees for setting up and doing all the transfers, but pretty minimal. And again, that's really kind of the only cash out of pocket, so to speak, usually $4 or $5 grand to get all of that set up and transferred. So those are probably the two most common things. Two other things I always want people to think about. One is really kind of on you. If you have equity in your home, being able to tap into that can be a really strong option for people to be able to use, right? Either in addition to one of the other things, maybe that's the cash component of this, or we've had people that have funded the whole thing based on the equity that they have in their home. The equity in most everybody's house over the last couple of years has skyrocketed. So there really can be a good option for folks. Then the last one is opposite of the SBA. We have some funding options and some partners that will do non-SBA kind of unsecured term loans and business lines of credit. So this could not possibly be more opposite than the SBA. So doesn't require any cash out of pocket, no cash injection, no post-closing liquidity, no cash. Credit score is still the same, like pretty strong 700 with low debt ratios and those type of things. You don't have to own a home with this, and it's going to fund typically in about 2 weeks. So it is super fast to get this. Basically loaning you free money for no cash down, nothing's collateralized, and you're going to get the money quickly, and it doesn't necessarily have anything to do with where you are, signing a franchise agreement, training, lease, all of those things. What's the catch? Fees are higher for the loan than the SBA one. The origination fees are higher for this. Typically, you just pull it out of whatever that loan amount is. So it kind of almost doesn't hurt as much because you didn't just cut a check for that. Interest rates are a little bit higher on the term loan, although that gap has lessened here the last couple months as the prime rate has gone up. But the rates are a little bit higher on the term loans. The lines of credit, and people can do both or either or. Lines of credit, oftentimes the interest rate is lower at the beginning, kind of that entry rate. I was equated to a credit card that's like, hey, you got 0 interest for 12 months. Something similar to that. And then a couple positives with, again, you still have the same fee being a little bit higher than the SBA. But then the other piece of this with the line of credit, two things is one, you're only repaying, if you get a line of credit of 100,000, but you only use 20, well, you're only paying back the 20,000. If you get a $100,000 loan, that's all plopped right into your account. You're paying back on the 100 grand. So it can lessen the payments. You're only paying off what you needed to tap into, number one. And number two, the line of credit stays open forever. So even when it gets back to a zero balance, it stays open. That fee you paid for it is basically amortized over infinity, right? So you can, that at any point is within your business, you want to grow. Maybe we need another staff member. We need another vehicle. We want to add another location. That line of credit can be excellent to be able to tap right back into. So it's quick, it's there, it's always there for you. You've got those things all kind of coming back into play with this. In most cases, starting a franchise is significantly more attainable than most people realize. It's not all like $1 million stuff. Yes, there are things out there like that, but the vast majority of the people are doing things that total investment are 200 or less. It is significantly easier. It is more attainable, and we're going to help guide you on this. Again, if you made it through this far, you're thinking about it, reach out to us, FranCoach.net, franchising101podcast.net, and help us create your better tomorrow.